The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you. You're listening to the Telltales Weekend Update. I'm Ava Cabot.
And I'm Marcus Graham, the Cash Flow Desk.
Quick note, the show is produced entirely with AI tools, and both voices you're hearing are AI generated. Send feedback through the Substack. We're still in pilot, so tell us what's working and what isn't. Here's the week. For 2 years, the AI trade was a story about chips. Who makes the fastest one? Who gets the allocation? This week, it turned into a different question, and it's a harder one. Who actually pays for the build? Broadcom printed a record and got punished for it. Oracle's about to walk into the same exam on Wednesday, and three of the biggest companies on Earth spent the week showing you three completely different ways to fund the thing: dilute, borrow, or rent. On Wednesday's main show, episode 2623, Hunt, Jason, and Mike framed the AI capex boom as the macro tailwind holding up a $31 trillion economy. We're going to put the cash flow lens on it, because the tailwind has an invoice attached, and this week the invoice started coming due. Start on page 1 of the memo, because Apple and Alphabet are sitting right next to each other this week, giving opposite answers to the same question. Alphabet chose dilution. The asset-light, beautiful business, the company that hadn't sold a share of stock since its IPO, just raised about $85 billion in an equity offering to fund its AI build, with Berkshire Hathaway taking $10 billion of it in a private placement. That's to cover a capital expenditure budget of $180 to $190 billion this year alone. Marcus, what does that raise tell you that the press release won't?
It tells you the cash machine stopped covering its own build. Going into this, the memo had Alphabet's trailing free cash flow falling 44% year over year. CapEx is eating it alive. You don't raise $85 billion in equity when your own cash flow funds the plan. You raise it when it doesn't. 69 times trailing free cash flow for a company now diluting shareholders to keep up. The beautiful business framing is over. This is a capital-intensive company that happens to own a search engine.
Meta took door number 2. Mark Zuckerberg spent the week reportedly floating an equity raise of his own to fund $125 to $145 billion of capex, and the stock fell almost 7% on Friday, just on the report that it might. Same week, he's hinting Meta might enter cloud computing to find an offset. Marcus, Meta's the one name here that doesn't actually need the money.
Right, and that's what makes it interesting. Meta still generates $50 billion of trailing free cash flow, and unlike Alphabet, it's still growing, up about 22%. At 32 times free cash flow, it's the cheapest name in this whole group. So when the best cash machine in the bunch is reportedly willing to dilute anyway, that's the tell. It's not that Meta can't fund the build, it's that the build is now big enough that even the best balance sheet here wants a cushion. The market saw the same thing. That's the sell-off.
And then there's Apple, on the same page, doing the thing nobody else in the arms race is doing. It's not building an AI brain, it's renting one. WWDC opens Monday, and the centerpiece reveal is Siri 2.0, powered by Google's Gemini. Apple is paying Google roughly $1 billion a year for access to a 1.2 trillion parameter model rather than train its own. Marcus, $1 billion a year. Everyone else is spending 100 times that.
And it might be the smartest line item in the whole sector. Apple throws off $129 billion of free cash flow a year, and it's still growing. $1 billion to rent the frontier is a rounding error against that, less than 1% of the cash Apple generates. At 35 times trailing free cash flow, Apple's letting everyone else spend hundreds of billions to build the capability, then buying the output wholesale, dilute, borrow, or rent. This week you got to watch all three, side by side. Only one of them doesn't cost the shareholder a thing.
3 doors, 1 invoice. Hold that thought, because the companies actually selling the shovels had their own reckoning this week. Page 2 of the memo, Broadcom and Oracle, back to back, and between them they tell you everything about how the market is grading AI infrastructure right now. Same business, same end market, 1 week apart. One company just delivered the print, the other has to deliver it on Wednesday. Here's the contrast on the table. Broadcom reported Wednesday, AI semiconductor revenue up 143% year over year to nearly $11 billion in a single quarter, a record. CEO Hock Tan stood up and said he has, quote, line of sight to $100 billion in AI chip revenue in 2027, and the stock fell 15%, on a record. Marcus, explain that one.
The market didn't sell the print, it sold the discipline. Going into this, the memo had Broadcom at 68 times trailing free cash flow, with 57% forward revenue growth baked in. At 68 times, you are not paying for what the company delivered. You're paying for the raise, for Tan to put a bigger number on the board. He didn't. He kept the 2027 target flat and refused to bump it. So the stock gave back the premium that was sitting there waiting for the bump. The business is flawless. The expectations were priced one notch higher than flawless. That's the whole 15% right there.
A record print, and the stock still falls. That's what a 68 multiple does to you. So that's the company that already reported. Now flip to Oracle, which walks into the exact same test Wednesday after the close. The setup? A backlog, remaining performance obligations of $553 billion, up 325% year over year. Cloud infrastructure revenue up 84%. The stock fell 8% Friday before it even reported, when a strong jobs number pushed rate cut hopes out. Marcus, Oracle's the one name on this page where you can't even use a multiple.
Right, and that's the most important thing to understand before Wednesday. Oracle's trailing free cash flow is negative, minus 21 billion. There is no enterprise value to free cash flow number because there's no free cash flow. They're spending it all on the build. So don't reach for a multiple. It'll just be a negative number that means nothing. What prices Oracle is one question. Does the backlog convert? 553 billion of contracted intent, growing 46% on the forward top line. If that's real revenue, the negative cash flow today is the cost of the build, exactly like Hunt said Wednesday. If it's optimistic paper, this is the most expensive backlog in software. Wednesday is the first data point on which one it is.
So connect the two. Broadcom got marked down for not raising the story. What does that do to Oracle's setup on Wednesday?
It raises the bar. Broadcom just taught the market that delivering isn't enough at these multiples. You have to deliver and beat the story you already sold. Oracle reports right into that mood. The $553 billion backlog is the story. If the cash behind it doesn't start showing up Wednesday, Oracle gets the Broadcom treatment. Except Oracle doesn't have positive free cash flow to cushion the fall. Same exam, 1 week later, harder grader.
And the one name standing behind both of them, selling the silicon into that whole build, had its own week. Marcus, NVIDIA.
NVIDIA is the supply that proves the demand both of these companies are selling. At the Taipei keynote this week, Jensen Huang said it flat, quote, Vera Rubin is in full production. That's the next generation architecture confirmed off the roadmap and into the fab. And he made the claim that, if it holds, is the entire moat. Quote, today, NVIDIA's token cost is the lowest in the world. His framing, not by a little, by orders of magnitude, against 41 times trailing free cash flow, that pricing power claim is the whole argument. And here's the tell the market usually waits for, the print to see. Per Talnex's hiring data, NVIDIA's AI engineering roles have been accelerating for weeks, and its customer deployment postings just spiked. That's not a chip research pattern. That's staffing to go deploy an installed base. Demand you can see in the job board before you see it in the revenue.
So the scoreboard for the week: Broadcom delivered and still got marked down. Oracle has to prove the backlog is real, and NVIDIA is hiring like the demand is already in the building. Imagine that. 3 quick ones, and then the forward week. First, Celsius. The energy drink story just picked up a regulator. Texas Attorney General Ken Paxton opened a formal investigation into Celsius and Alani Nu over alleged deceptive marketing to minors. And that's a fresh overhang on top of margin pressure the company's already flagged as it digests the Alani Nu and Rockstar acquisitions. The stock's been telling you about the margin worry. Now there's a legal one too. Second, Five Below, and this one's just a clean beat. Comparable sales up almost 23%. Adjusted earnings beat the street by more than 30%, and management raised the full-year guide. In a week when half of retail is talking about a cautious consumer, Five Below printed the quarter the rest of the sector wishes it had. Third, Vertex, a pipeline name doing pipeline things. The FDA accepted Vertex's application for povetacicept in IgA nephropathy, a kidney disease, with a decision date set for the end of November. That stacks on top of the cystic fibrosis franchise and the new non-opioid painkiller. Vertex isn't a one-drug company anymore, and the back half of this year is a string of catalysts. And the forward week: Oracle is the marquee print. Wednesday after the close, and you just heard why it matters. Lennar reports Thursday, and watch the gross margin. It collapsed to about 15% last quarter on the heaviest incentive since 2010, and the question is whether that was the floor. Then, looking out, CarMax reports the following Wednesday, June 17th. FedEx reports June 23rd, its first quarter as a pure-play express network after spinning off its freight business and pulling out about $4 billion in cash. And keep an eye on Lantheus. There's a reported $7 billion takeover interest and an FDA decision both landing this month. Cheapest name in our biotech set, 2 binary events, 1 window. That's the show. Wall Street's consensus on the AI infrastructure week. Broadcom stumbled, Oracle's the safe re-rate, and the hyperscalers can fund this forever. I'd put all 3 on the watch list because all 3 are about to be tested. Here's the through line to take into Monday. This was the week the AI trade stopped being about the chips and became a question about who pays for them. Dilute, borrow, or rent on the demand side. Deliver the backlog or don't on the supply side. The capex is real, the tailwind is real, and now, finally, so is the bill. One more thing. The hiring data we cited this week is from TalNexus, talnexus.com. You can pull up the cash flow memo yourself at telltales.us. And Hunt, Jason, and Mike are back Wednesday on episode 2624, continuing the healthcare and deficit thread. We'll see you next Saturday. The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security, nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the host nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, express or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.